When overwhelming debt becomes a burden, finding a pathway to financial freedom can feel like navigating a complex maze. Freedom Debt Relief is one of the largest and most well-known companies in the debt relief industry, primarily specializing in debt settlement. However, it's crucial for anyone considering their services to understand exactly what debt settlement entails and to weigh it against other available options. As a finance expert, my goal here is to demystify these processes and help you determine which Freedom Debt Relief method, or alternative, might be best for your unique situation. Understanding Freedom Debt Relief's primary method, debt settlement. Freedom Debt Relief, FDR, is a debt settlement company. This means their core service is to negotiate with your unsecured creditors, like credit card companies, personal loan lenders, and medical bill providers, to accept a lower lump sum payment than what you actually owe. The idea is that creditors might prefer to get some money back rather than potentially losing it all if you were to declare bankruptcy. Here's how their debt settlement process generally works. Enrollment and assessment. You contact FDR for a free consultation. They'll review your financial situation, including your income, expenses, and types of unsecured debt, to determine if debt settlement is a suitable option for you. They typically require a minimum amount of unsecured debt, often around $7,500 or more. Stop paying creditors. Crucial step if you enroll. A key part of the debt settlement strategy is that you stop making direct payments to your creditors on the enrolled debts. This is done to show creditors that you are experiencing a financial hardship and are unable to pay the full amount. Dedicated savings account. Instead of paying creditors, you make regular monthly deposits into a special FDIC-insured dedicated account that you control. This money accumulates over time and will be used to fund the eventual settlements. Negotiation. Once a sufficient amount of funds has accumulated in your dedicated account, FDR's negotiators begin contacting your creditors. They will attempt to persuade creditors to accept a reduced amount as a full settlement of your debt. This can involve multiple rounds of negotiation. Settlement and fees. When a settlement offer is reached, FDR will present it to you for approval. If you agree, the agreed-upon amount is paid from your dedicated account to the creditor. At this point, Freedom Debt Relief also takes its negotiated fee, which is typically a percentage, often 15% to 25% of the original enrolled debt amount. Program completion. This process repeats for each enrolled debt until all of them are settled. The program typically takes 24 to 48 months, though it can vary based on individual circumstances and how quickly funds accumulate. The best debt relief method isn't one size fits all. When considering which Freedom Debt Relief method is best, it's vital to recognize that Freedom Debt Relief primarily offers one method, debt settlement. However, when people ask this question, they're often implicitly comparing debt settlement to other broader debt relief strategies. Let's analyze whether debt settlement, or an alternative, is truly best for your situation. The potential upsides of debt settlement with Freedom Debt Relief. Potential to pay less than you owe. This is the biggest draw. You could resolve your unsecured debts for less than the full balance. One monthly payment. Instead of multiple payments to various creditors, you make one consolidated payment into your dedicated account. Avoid bankruptcy. Potentially for those facing bankruptcy, debt settlement can be an alternative, though it has its own significant drawbacks. Professional negotiation. Freedom Debt Relief has experienced negotiators who handle the communication with creditors on your behalf. The significant downsides and risks of debt settlement. It's crucial to be fully aware of the serious downsides. Severe credit score damage. When you stop paying your creditors, your accounts become delinquent. This will cause a significant and lasting negative impact on your credit score, which can remain on your credit report for up to 7 years. Even after settlement, the account will likely be reported as settled for less than the full amount, which is less favorable than paid in full. Interest and fees continue to accrue. While you're saving money in the dedicated account, interest, late fees, and penalties continue to pile up on your original debts. If a settlement isn't reached, you could owe even more than you started with. Risk of lawsuits. Creditors are not obligated to negotiate or settle. During the period you're not paying them, They can pursue aggressive collection efforts, including lawsuits. If sued, you could face wage garnishment or liens. Debt settlement companies generally do not provide legal assistance if a creditor sues you. Tax implications. Any amount of debt that is forgiven, i.e., the difference between what you owed and what you settled for, over $600 is generally considered taxable income by the IRS. This means you could receive a 1099-C form and owe taxes on the save amount. Fees. Freedom Debt Relief charges a fee, typically 15% to 25% of the original enrolled debt. When combined with the taxable forgiven debt, the total amount you end up paying can be surprisingly close to, or even more than, your original debt, depending on the settlement percentage. Not all debts are eligible. Secure debts, like mortgages or auto loans, federal student loans, and certain other types of debt cannot be settled through this process. Alternatives to debt settlement. Exploring other avenues. Given the risks of debt settlement, it's often prudent to explore other debt relief methods before committing. These might be best for you depending on your circumstances. Debt Management Plan, DMP, via credit counseling. How it works. A nonprofit credit counseling agency helps you create a budget and negotiates with your creditors to lower your interest rates and monthly payments. You make one consolidated monthly payment to the agency, and they distribute it to your creditors. Pros. Less damaging to credit than debt settlement. Accounts are often reported as paid as agreed or managed by counseling agency. Lower interest rates. Fixed repayment term. No taxes on forgiven debt. Cons. You still pay back 100% of your debt. No principal reduction. Requires regular payments. May involve a small monthly fee to the agency. Best for individuals with steady income who can afford reduced payments and want to minimize credit damage. Debt consolidation loan. How it works. You take out a new, single loan, often a personal loan, with a lower interest rate to pay off multiple high-interest debts, like credit cards. Pros. Simplifies payments to one creditor, potentially lowers interest costs and monthly payments. Can help credit if managed well. Cons. Requires good to excellent credit to qualify for favorable rates. Doesn't reduce the principal owed. If you continue to accrue new debt, you'll be in a worse position.